Gold is a peculiar asset to invest in. It doesn't produce an income like bonds, it doesn't represent something that produces product or provides services like stock, and it doesn't even help to meet a human need like real estate does for shelter. And yet, it's been a big player in the financial world for thousands of years. And even today, when its more recent role as a guarantor of currency value has largely been removed, it still finds itself in the portfolio of many investors. But why is that? By all logic, it should be one of the dumbest investments any of us could ever make. So why is it still so popular? Well, after months of examining different investing strategies on this channel, I've noticed a trend. Strategies that invest a good portion of their money in gold are, relative to other strategies, very dependable. Today we're going to be discussing why that seems to have been the case historically, and what trade-offs, if any, gold-heavy strategies make in order to achieve that higher level of dependability, so that you can decide for yourself if gold is a good investment for you. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. There are 3 gold-heavy portfolios that we're going to be examining today to illustrate why they've been so dependable and what they may be giving up for that dependability. The permanent portfolio, the golden butterfly, and the max FI portfolio, which is one of my own creation. I choose these portfolios because they give us a good look at how different levels of gold investment lead to differing levels of dependability. The permanent portfolio has the most gold, with 25% of the allocation being devoted to it. The golden butterfly is next, with 20% going towards gold, and the max FI strategy comes in at third, with 15%. All 3 of the allocations are above the upper limit of 10% that's often recommended by investing professionals to those who are going to be investing some of their money into gold, so they would be considered gold-heavy allocations. We'll be comparing these portfolios against other allocations that don't invest in gold at all, such as an all-stock portfolio, which will be represented entirely by a large cap blend index fund like the S&P 500, and a classic 60-40 portfolio. The metrics we're going to be looking at mostly fall under the consistency, tranquility, and resiliency categories because truly dependable strategies will usually have a few things in common. Their year-to-year returns will not vary by too much, they won't lose a ton of money very often, and whenever they do fall in value, they won't take very long to recover. Therefore, we'll be paying particular attention to each strategy's standard deviation of returns, its loss frequency and severity, its downturn durations, and its time spent in either correction or crash territory. This will help to paint the picture of why we see the start date sensitivity figures that we do with these gold-heavy strategies. So on your screen now, you'll see the standard deviation of real returns for each of the 5 strategies since 1927. You'll notice that the 2 most consistent portfolios, as measured by standard deviation of real returns during this time frame, were the 2 with the most gold in them, the permanent portfolio and the golden butterfly, with standard deviations of 8.6% and 10% respectively. The classic 60-40 approach came close to matching them at 11.9%, but it did settle for 3rd place in this lineup. Now, this does not necessarily mean that gold, in and of itself, makes an allocation more consistent year to year. I mean, it might in some cases, but gold can be fairly volatile over the short term, not unlike stocks. What might be happening here is that the portfolios that tend to put more money into gold are simply taking that money away from stocks, which have historically been a little bit more volatile. And if we line up the allocations in the order from lowest to highest equity allocation, we see that as you add more stocks into the equation, consistency does typically go down. The loss frequency and severity metrics all follow the same pattern as those consistency metrics, with gold perhaps playing some role, but the correlation between higher equity allocations and more frequent and severe downturns being undeniable. But on the resiliency side of things, we notice that the gold-heavy portfolios once again show their strength by having the shortest average downturn durations. In fact, the max FI strategy, which puts a whopping 70% of its funds towards equities and has more severe downturns on average and at its worst than any of these allocations other than the S&P 500 approach, still somehow manages to have the shortest average and maximum downturn durations at just over 2 years and 7 years respectively. It falls back to being slightly behind the classic 60-40 strategy in terms of time spent in correction or crash territory, but the even more gold-heavy allocations still rise to the top of that list. Together, these edges lead to a higher level of dependability for the more gold-heavy portfolios. When measuring dependability using 10-year start date sensitivity figures, we see that the gold-heavy portfolios sweep the podium, with the permanent portfolio leading the way with a total start date sensitivity of just 16.2%, closely followed by the golden butterfly at 16.6%, and then the max FI strategy, despite having so much stocks in it, coming in third at 21.7%. The results are the same when looking at the average start date sensitivity. So it would seem that gold-heavy portfolios really do stand out when it comes to the dependability or trustworthiness of long-term real returns, and they often have shorter downturn durations. Gold may be playing some role in the short-term consistency of returns and limiting downturn frequency and severity, but it seems that the larger player in that field is probably the amount of money that the strategy is having investors put into stocks. With that being said, why are gold-heavy portfolios so dependable? And what allows them to recover from those downturns quicker than their goldless counterparts? Well, as far as I can tell, there are 4 major reasons why gold-heavy portfolios have historically been some of the most dependable options out there. First, they've historically offered solid inflation protection, particularly during truly high inflation periods, such as the 1970s and early 1980s. Second, the returns of gold aren't too strongly correlated with the returns of stocks and bonds. Third, the value of gold was artificially held constant during much of the 20th century. And fourth, as we've already mentioned, the extra money that you put into gold has to come from somewhere, and with most of these gold-heavy strategies, that somewhere ends up being stocks. So to examine these in a bit more detail, the first reason gold-heavy strategies have been so historically dependable is the additional inflation protection they provide. This was perhaps most noteworthy during the first half of the 1970s and the early 1980s. As mentioned before, gold had artificially been kept at a steady value for much of the 20th century, but that wasn't the case in the 1970s. Between 1971 and 75, inflation rose by 31% in total. Gold grew by an annualized average of roughly 37% per year before inflation. In fact, during that time, a $10,000 investment in gold would have grown to over $48,000. A $10,000 investment into our large cap blend fund would have actually fallen to around $8,800 during that time. And that's before factoring in inflation as well. The story was much the same when inflation began ramping back up again in the late 1970s and into the early 1980s. From 1978 to 81, inflation rose by 39% in total, while gold grew by roughly a nominal 43% per year, turning $10,000 into $42,000 during that time. It did fall a bit in 1981 and would fall more in 1982, but not nearly enough to put it behind inflation, or for that matter, stocks, which grew by about 11% per year during this time frame. Enough to keep pace with inflation, no doubt, but not a whole heck of a lot more. Given that times of sustained levels of high inflation are some of the most difficult times to be an investor, because it seems that just about every traditional investment is struggling to keep its head above water in real terms, this is definitely something to take into consideration when choosing your desired asset allocation. Granted, gold is not the only investment that did well during this time, or the only hedge against inflation historically, but it still does seem to contribute to the dependability of these gold-heavy portfolios. The second reason for gold-heavy strategies being so historically dependable is the fact that they aren't too strongly correlated with other common investments like stocks and bonds. Now, that's not to say that they are necessarily the least correlated asset to either of those investments, but there is quite a bit of divergence. For instance, since 1970, the correlation between the returns of gold and the returns of a total stock market index is about negative 0.1. The correlation between the returns of a total bond market index and gold is about negative 0.07, so not a strong correlation in either case. This leads to more stable returns when the investments are paired together and rebalanced regularly. Take a look at the following hypothetical returns, for instance. These returns aren't based on anything historical. I just randomly generated returns on a spreadsheet and made sure that they weren't too strongly correlated with one another to give us an idea of how this uncorrelated thing works. As we can see in this particular hypothetical, the returns of our all gold allocation would have led to the highest overall growth. The most stable and dependable option was actually an equal mix of stocks, bonds, and gold. It lost money the least frequently, its worst downturn was the least severe, and its growth was just a few tenths of a percentage point behind the all-gold approach. The third reason for gold-heavy strategies being so historically dependable is one that I've already mentioned, so I won't go into too much more detail on it, and that's that the gold-heavy portfolios usually invest less of their money into stocks than other strategies. Like I said before, the fact remains that if you're putting 15, 20, or 25% of your money towards gold, that money has to come from somewhere, and that somewhere is usually stocks. The reason that it usually comes from stocks and not bonds is that bonds are what give you the year-to-year consistency. Stocks are volatile. Gold is volatile. Relative to most other investments out there, bonds are pretty stable. So you could pull the money from bonds, but you'd probably lose some of that consistency, which would also lead to less dependability in the portfolio when all is said and done. The fourth reason for gold-heavy strategies being so historically dependable is the fact that its value was held constant for much of the 20th century. This one is also pretty self-explanatory. If the value of an investment doesn't change, your returns from holding it will be incredibly dependable. They'll be zero, sure, so nobody's going to want to hold on to it unless everything else is going down, but they will be very dependably zero. So in the end, gold-heavy portfolios have historically been more dependable for a number of reasons. They offer some additional inflation protection and have been capable of offering it even when some other economic conditions are not ideal. Their returns have had little correlation with other common investments like stocks and bonds, which allow the overall returns for the whole portfolio to be more stable. In order to add gold to an asset allocation, you've got to remove money from some other asset, and that asset is usually stocks, which tend to be more volatile and less dependable. And, if you're looking back far enough, the value of gold was held constant for many years during the 20th century, which tended to help in the dependability category, though not the long-term growth category. What they tend to give up in order to achieve this dependability is some long-term returns. The growth ceiling on these types of allocations is generally not quite as high, largely because gold is being added in place of stocks, which tend to have some of the highest long-term returns of any of the traditional asset classes. If the portfolio also targets assets meant to provide additional tranquility, like cash in the permanent portfolio, that can further drag down long-term returns, especially since the money that's being put towards the more tranquil assets usually comes from the least tranquil assets, like stocks. Now that doesn't mean that gold-heavy portfolios always have horrible returns. I mean, the Golden Butterfly has an average 40-year inflation-adjusted return of about 6.5% per year based on the data I have going back to 1970, which is not too far behind many of the all-stock portfolios, including a large-cap blend portfolio, which has an average real growth rate of just under 7% during that same time frame. And over more intermediate time frames, such as 10, 15, or 20 years, which, depending on your financial situation and goals, might actually be a much more relevant time frame to examine for you, these gold-heavy allocations can even outperform their more stock-heavy counterparts because of those things that make them so much more dependable. But generally speaking, subbing in gold for stocks usually leads to a little bit lower long-term returns. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.